Mastering supply and demand in trading is one of the most important skills you can learn as a trader, and failing to learn it can be a disaster. In this video, you'll get an in-depth guide to mastering supply and demand from our head of trader development, Jeff Holden. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005 and proud to have developed numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from a professional trader on our desk so you can grow your trading account.
In this mini course, we're going to define supply and demand the way we talk about it on the desk. There's a little nuance to it, so pay attention. We're going to talk about how you can use it to increase the probability of actually any trade that you're going to take by looking at the components of how supply and demand are playing out. We're going to talk about specifically how to identify supply and demand early. It's different than what a lot of people talk about. So let's get into that. And then we're going to talk through 3 essential steps when you're trading with supply and demand. Finally, we're going to wrap up everything by going through 4 specific trades that we take on the desk that use supply and demand effectively as important components of the trade. The first thing we're going to do is we're going to talk about defining supply and demand. So how do we define supply and demand? Well, supply is obviously sellers, right? It's where this imbalance occurs, where there's more sellers than buyers. That's what drives that down. Excess supply can be very prevalent and show up in a very aggressive manner, but the reality is it can also be very, very passive. It can be tricky, and that trickiness actually is what makes it so beautiful. Because before that aggressive big candled move starts, there's a lot of subtlety. And we can see that shift in the supply that's in the market right now. That little subtle shift is where we're going to start with a lot of our focus, because that big aggressive move comes way later. So many people want to focus on the aggressive move. That's really not a great way to do it. You want to notice the subtlety and that change that leads into that aggressive move, and then take advantage of both those. So supply is essentially just sellers, big players in the market that have a lot of shares to sell. Demand is essentially anybody that needs to get in. Demand is broken up into a couple different categories. Sometimes demand is people who need to cover a short. They'll act in a very urgent manner. Sometimes it's people who want to passively buy the stock. Again, coming back to that 2 components of supply and demand, passive and aggressive. One thing that really bothers us and trips up too many people: supply and demand are not support and resistance. Support and resistance are areas that are created by prior price action. That can line up with supply and demand at different times, but support and resistance are distinct points that are very different than the flex component that we're talking about with supply and demand. That's why it's important for us to break it down. That's why it's important for us to understand. Let's go back to that point again. It's not support and resistance. Supply and demand is bigger traders, those big players in the market. They're in the market and they're involved in the stocks because of a distinct shift. This shift can always have a couple reasons, which we'll get into, especially when we talk about the trades that we're taking. But think about it as that distinct change, a catalyst. That catalyst actually blows the support and resistance components that can lead to those predictable moves that support and resistance traders trade. It blows them completely out of the water because supply and demand components override any support and resistance components in the right environment. It makes support and resistance actually wildly unpredictable. So if we shift our thinking to know what supply and demand are, know how they show up in markets and what it means, we can use that catalyst and we can show up and trade along with the big players coming in and disrupting that underlying balance that support and resistance traders like so much. This slight and subtle shift in our thinking gets us halfway to correctly identifying supply and demand. We talked about this point already, but let's go a little deeper now. Supply and demand is not just aggressive buying and selling. It would be so nice and so easy, and it seems really easy if we talk about it from the perspective that supply and demand always are going to be identified using those big aggressive candles. That's what supply and demand are. They're big candles that show up on the chart. But experience has really taught us that that's not the case. We have to be so careful with this misconception because it can really lead to this false expectation. And it really kind of sets a bad, awful trap that a lot of traders can fall into. You think you're trading supply and demand when you're trading these big aggressive candles, but you're really trading the end of that supply and demand. The worst part of it is it can lead us into missing out on some of the actual highest probability trades offered by those big players when the supply and demand components show up passively first and then aggressively later. Most supply and demand trading in the markets that we trade now, they do show up passively. It's this beautiful, subtle, but distinct shift. It's this noticeable pattern. One that produces the kind of trades that leave us just kind of hungry for more. The trades that feel right from the moment we put them on. The kind of trades that leave us with that feeling of connection, that feeling of flow with the market we're trading. So let's break it down. So supply and demand trading is a catalyst. It's a change in the balance that shows up as first passive and then aggressive participation. If we're talking about longs, we're talking mostly about passive buying into aggressive buying, and then that flow back to passive buying into aggressive buying. Those two components, that catalyst and then that passive and aggressive component, have laid the groundwork we now know how to use and how to identify appropriately supply and demand. And that's how we increase the probability on any trade. Our second point is how you can use supply and demand to increase the probability of almost any trade. In reality, in trading, we don't need much of an edge in trading to be insanely profitable. We do need a real edge. We need trades with real edge. So let's cover one trade with the real edge, and then as we progress through this supply and demand course, we'll cover those other four near the end. But once we have a trade with real world edge, we can use the supply and demand component to enhance the probability of a trade, whether it's a scalp, a move to move trade, a trade to hold, whatever time frame of the trade. Applying the simple, direct principles of supply and demand trading learned here are likely to bring us into that flow where trading just makes sense, where the edges are stacked in our favor. It's that kind of feeling where maybe you get tricked into thinking this could go a little further than I think. So you want to have those problems in your trading. You don't want to be in a position where you're putting the trade on and as soon as you put it on, it starts to go against you. Applying the principles of supply and demand take an existing edge and allow us to hop a ride on with the big players as they kind of go about their day. It can literally feel like you're sitting down to a blackjack table with a positively stacked deck. As soon as you sit down, you know if you play the right way, if you play your games with some edge, you're likely to see those follow through over and over and over again. Most people will skip over this. We're not going to. We're going to get dirty a little bit, but then we're going to come out with a new sense of how supply and demand really shows up in the actual charts we're trading now. How to identify unusual supply and demand early. This is that passive supply, passive demand. Aggressive is always going to show up as very clear full bodies. You can very easily define aggressive supply or aggressive demand as 3 full body candles. If it's a 1 minute or a 2 minute or a 5 minute or a 15 minute, whatever time frame you're trading on, even an hourly, when you see 3 full bodied, not a lot of wicks on there, of the same color, same direction, that can be classified as aggressive supply if the candles are red and they're going to the downside, or demand if the candles are green and going to the upside. Once we have that, we've identified aggressive supply and aggressive demand. When do we expect there to be a lot of aggressive supply and aggressive demand? When there's higher volatility. significantly heightened volatility. That means maybe the move's already started and then it gets aggressive. That's also prone to much more reversion. So you can see really aggressive supply leading into really aggressive demand, like we see on the chart right here. It makes it dangerous to trade along with the supply in that environment. It makes it dangerous to trade against the demand in that environment. You want to know when to trade aggressive supply and demand and when to look to be comfortable, focused on the passive supply and demand. A simple way to identify passive supply or passive demand is when you have a 3-to-1 ratio. So when you have one large green candle, let's say, and then the next 3 consecutive candles are red, and they take out the entirety of that one green candle. Most of the time, that's showing us that passive but sustained supply, where it looked like there was demand on that green candle, but there's passive and sustained supply right there. That can be the beginning setup for a really big move. It doesn't always show up with that one big candle and then that 3 very clean candles. Sometimes it shows up as the one candle, some sideways action, and then those 3 very distinct, very subtle, but distinct red candles. We're always looking for that 3-to-1 ratio when we're trading supply and demand because we're not trying to get caught in the middle on any of it. We're trying to appropriately identify when that balance has shifted. And a 3-to-1 ratio tends to be about the appropriate ratio for looking at supply and demand changes in the tape. Here are 3 essential steps for trading with supply and demand. These are going to set up the trades that we're actually going to take. So we need to cover those 3 essential steps. We're going to start by looking at the initiation of where that supply or demand started from. And then we're going to allow that to play out and look for a reinitiation. So again, if we're seeing something passive, let's see where that passive supply started from or that passive demand started from. Let's see it take out that level. Let's see a reinitiation of that trade. That's where we're going to focus, is on the reinitiation of that supply or demand. And then we're going to focus on measured targets. Measured targets using supply and demand. Some people will talk about Fibonacci's. Some people will talk about measured move. Some people will talk about it trading into a prior resistance or support area, another area of supply or demand. The reality is, at the end of the day, what we found is measured moves. So measuring where the initiation occurred to where the reinitiation occurred, that tends to be the best way to set targets for supply and demand trading. Now let's get into the good stuff, the stuff we've all been waiting for, the specific trades we can take using supply and demand effectively. So these are going to be 4 trades that we take on the desk. One's in the open, right on the opening drive. Another's the morning trade. Then there's a midday trade, and then there's an afternoon trade. You don't have to add all 4 of these to your playbook. Probably most people won't. You'll find 1 or maybe 2 of them that make a lot of sense to you. On the desk, you'll see people taking breaks after the open, after the morning. During the midday, maybe we'll get some lunch or they'll kind of be a little more passive and looking for some very specific patterns to occur. But then in the afternoon, everybody will get focused again. Breaking our day up into these quarters allows us to stay in that flow of what's happening with the supply and demand components because they are always adjusting subtly, but they are adjusting in markets. Let's start with an opening drive trade. The opening drive trade we're talking about is the gap, give, and go. You'll see a little bit of a visual reference right there, but let's walk through it together. For the gap, give, and go, you get a gap up, you see a give. Price action pulls in a little bit from the open. It usually has to be pretty aggressive as well. We don't want a methodical, slow, grindy give. We want to see a pretty aggressive give right from the open. So let's get that give. And then what we're looking for on that give, what actually happens is sellers that are taking their profits, that supply that was ready to enter the market hits the market right from the open, causes that drop, that give portion. It should be aggressive. That supply should be aggressive. And then we develop this really nice, usually consolidation. The difference between a range and consolidation, a range would be wide and it could just chop around as long as it wants to. A consolidation usually is a little bit tighter because there's a pending resolution to that. So we get this consolidation down into an area of demand. The area is created by the buyers that are looking to go with that gap. What happens is there's this short-term balance between supply and demand. And in the gap give and go trade, we're looking for and expecting that the buyers that demand will step back in and take us higher. This is probably the most basic component of that trade, of supply and demand trading, because it's very simple and we see it very clearly on the tape. When we look at example after example, you can see that give, that excessive, very abrupt supply. You can see that demand step in. And then you see that urgency of the demand increase as the supply completely evaporates. You see the buyer step up. This is almost always a two-leg trade because we expect that demand to be sustained. We put our stop below the low of where that demand was. And we look for two waves because we expect that demand to occur, the pull in, that balance point, and then that reinitiation point. As that area develops right at the lows, we're waiting for it to crack. Once it breaks to the upside, we can enter our position right there. Again, stop at the low below the area where the demand was. And we look for one move, and then that pull in, and then a reinitiation of that demand, and that second move. After that second move, which you can use a double measured move target if you want to, you take the spot from where the initial demand started to where that initial supply kind of met us. And then that pull in came in. And then on that reinitiation, we're looking for another leg that should be equal to that first leg higher. Sometimes it's even more. After we're done with the open, a lot of times you'll see traders reset, kind of look around and see what else is out there. What other in-play names are trading? Here's a second trade that you'll see traders on the desk make. It's called the Good Morning America. What happens in this trade and why using supply and demand components can really help drive us in the right direction is because this is an opening range that develops. But unlike an opening range break, the range takes about 30 to 45 minutes, sometimes longer, to develop. So it's not really an opening range break. And when it takes that long to develop, a range break's actually a little bit prone to failure initially. So what we do is we take the components of that trade, look for where there was supply, which created the top of the range, and demand, which created the low of the range. And then we look for that shift, that subtle shift to occur. A lot of times that shift will start at the lows. So we'll see a really hard down move where it looks like there's a ton of supply. But then that sustained buying pressure, that sustained demand that does that reclaim of the entire down move. And then that's the beginning part of our trade. What we actually look for in this trade is we had that up move, down move, up move, and then an abrupt down move. And then we have 1, 2, 3. That's just the setup for this trade. What we're actually looking for is a reinitiation after the demand has been holding above that area where there was supply previously. Observing that reinitiation gives us an opportunity to take our trade. We take it on the break of the top of the current range or of the extended range. We put our stop just below the area of the break. This gives us killer risk reward because as the trade starts to work, we're risking a very small amount. And what we're really trying to walk into is a trending trade to the upside. So what we're expecting on this is that supply and demand imbalance that occurred is going to result in an aggressive approach of demand. It's going to result in those aggressive buyers taking us all the way out. We can risk a small amount, but what's our actual target? Since we're initiating there, on the break, and then our stop is just below the lows of that small consolidation, that area of demand, we're actually using a target of the entirety of the range. So if our range is built out, and then we get this little consolidation here, our stop can go right below the area of that mini consolidation. Our entry would be right above the area of the mini consolidation. But we're using the measured move of the entirety of that consolidation as our target. So this gives us amazing risk to reward. Our expectation is not that it will be aggressive first. Our expectation is that demand is sustained, but it's passive. That's why it didn't just break out and make this giant move to begin with. It's passive demand. Passive demand can lead to aggressive demand later. We don't have to always look for that aggressive demand. Sometimes it occurs at the end of the move, and that's where we want to exit our position. Our third trade is something that occurs sometimes in the morning, but most often, and one of the best times of day for it, we've found, especially in the markets that we're trading right now, is a midday style trade. So what's happened is maybe there was something that was selling off through the open, and then it started to put in a low in the morning and then put in a little bit of a consolidation, and it's giving us an opportunity for a really nice scalp. We call this the backside scalp. It's a great midday trade, midday being like 11:30-ish to 1:30 or something like that. It's a great trade because it tends to catch people a little off guard. But if you're ready for it and you're just sitting at your seat, or maybe you went and got some lunch and came back and were surprised that there was some buying pressure off the lows, let's say, you can walk into a really good scalp. And let's break out where the supply and demand components come into play. So for this scalp, we're going to talk about there being some selling pressure on the open. A lot of times that's sustained selling pressure that gets a little more aggressive later in the day. It's just a really common pattern for that sets up the backside scalp. Then we're going to want to see some demand come in. Again, this is all something that happened in the morning. We're not worried about taking that trade off the low. What we're thinking about is if the price action kind of comes in, puts in a distinct higher low, and then puts in some sort of consolidation, we can then look across and notice, where is that entire consolidation occurring? Is it occurring below an area that could be where excessive supply was? Or has that supply now turned into potential demand? When that area, this consolidation, is occurring above an area that could have been referenced as supply, we can now use that switch of those components to take advantage of the opportunity presented by those aggressive shorts and look for a very distinct break of the range with our stop below here and a quick, fast target of VWAP. What's really happening with that trade is all the supply that was there on the open is exhausted. But traders are still looking at price saying, well, I think there's going to be more supply there. What is really going on is it's shown nothing but demand for the last period of time. Since the lows were put in, there's a very clear and distinct big player that's present. So what we're doing is we're allowing the price action to move around a little bit, but then allowing it to set up this very important moment for us, which is that consolidation. As soon as that consolidation breaks to the upside, we can enter our trade. Our stop is below that higher low, and we're targeting VWAP. It's a little scalp that you'll see traders in the desk do. It's a little thing that doesn't seem like that much, but you do it effectively and it adds up really, really quickly. It uses the components of that subtlety of maybe aggressive demand off the lows into passive demand. Where there once was aggressive supply, now there was aggressive demand, and now there's passive demand. And the way that we're entering our trade off of that passive demand is now we're looking for aggressive demand to give us a reason to exit. Finally, the last trade that we're going to cover is something we call above the clouds. It's a trade that was inspired by one of the people on our desk. He loves hiking. He took this beautiful picture, and it was a picture where literally he was above all the clouds. It was unbelievable. That day, or maybe a day later, we were all trading, and this stock just made this move that went up through the day, and it held above all of the area of prior resistance. It was just holding above the clouds. In the afternoon, that can signify the potential that this stock is going to close high of day. So what we do to identify this trade, into the afternoon, we look around at the stocks that were in play. If we see something that is put in a range where there's maybe some supply and there's some demand, then we wait for that range to get broken to the upside. We confirm that the demand is there by seeing the supply turn into demand. The price action has to hold above those clouds. It has to hold above that prior supply area. If it does this, and ideally the time frame that it'll do it is about 10 to 15 minutes, sometimes 20 minutes, but if it does that and it breaks to the upside, we can risk against that area of prior supply now we're observing as current demand. And we can look for, again, a measured move of the entirety of the range. Or if we're trading this for close of high of day, we can just hold it till the end of the day. It's very similar to the morning trade, but the components there are different. Because in the morning trade, we're expecting it to be more of a trending trade. We're expecting that demand to be subtle and then grow and then get more aggressive. In the afternoon, in the above the clouds trade, we're actually expecting aggressive demand. We're expecting aggressive demand from the initiation of our trade. If it doesn't go in our favor relatively quickly, it's probably not going to work out as well as we think. So with this trade, we have an expectation that it'll start to work quickly, and then it'll start to get a little more subtle. But we're looking for that very clear and distinct change where supply turned into demand. And then we're looking to go with that on that continuation, that reinitiation to the upside. So we talked about measured moves being our primary exit strategy. You know, we measure the range or we measure the move of that demand. There's a really great video that we put together that talks about a lot of different ways to exit trades. And if you've been struggling in your trading, or you're in a position where you're in trades and they're starting to go for you, but you feel like you're giving too much back, go check out that video because it's a really good guide of different ways that you can use exit strategies in different situations, different trades entirely.